Hi, I'm Max Keiser, and this is the Keiser Report. Markets, finance, and scandal. Oh, there are just so many scandals. We need, so many more programs to cover them all, but let's get to it. Stacy Herbert, what do you got?
Max Keiser,
Yeah.
I have this headline: a banana republic with no bananas.
Really? Tell us about it.
I see you come armed
You don't
with a
mind if I
banana.
eat my banana, do you? I mean, this is a real banana, but you have a banana republic without the bananas.
Of course, this is referring to the United States.
Oh, yes.
This is Washington's blog, and they look at whether or not America is, in fact, a banana republic. So he looks at the four key definitions of a banana republic.
Yeah.
Number one, the first feature of a banana republic: profits are privatized and debts socialized. This, of course, comes between the collusion between an overweening state and certain favored monopolistic concerns.
Overweening.
So we've seen this in the United States, of course, with monopolies on the banking sector, the telecom sector, the oil sector. You know, they all get their own favors from the state.
Yeah.
Number two, devalued paper currency in the international community. Mm-hmm. So you look at the dollar chart, you see it's been on a downward death spiral for the last 90 years or so.
Oh, yeah.
Number three, politicians use time in office to maximize their own gains. So you think of the entire lobbying industry, all those ex-politicians who, as soon as they leave Washington, jump right into a lobby firm in K Street. Number four, corruption remains unchecked. Politicians are only for show. So politicians are for sale, there is zero accountability, and they only serve the function of rubber stamping any legislation that the lobbyists for the corporations put in front of them. So with that final one, check out this headline.
Oh, yeah.
Fed shouldn't reveal crisis loans. Banks vow to tell High Court. So remember, on March 19th, the U.S. Court of Appeals in Manhattan ruled that the central bank must disclose to whom they lent the $2 trillion
Right.
in emergency loans. Now, the big commercial banks, those monopolistic concerns that are very close to power, have vowed to now fight this.
That's right. The banks are fighting any attempt for regulation. Let me explain something to you. This is basically the banking system. The bottom layer here are the deposits. This is what people give banks to hold on to them. The top part here are the loans that banks make based on the deposits. Now, before the 1929 crash in America, the loan-to-deposit ratio got about 10 to 1 or so, something along these lines. This is about the tower of debt that was on top of the market at that time. And then, of course, it crashed. Now, before the 2008 collapse we saw in America and around the world, it got to about 50 to 60 to 1 leverage of the debt to the deposit, to the equity. This is what prompted the crash. And the reason why bankers love to create this type of debt tower, leaning tower of debt, is because they get paid on the debt. They get paid on the loans on top of the deposits. They don't get paid on the deposits. There's no money to be made in the actual business of banking. The only money you can make these days is in this financial terrorist scheme. So now, what do we have today? Thanks to the bailouts of J.P. Morgan and Goldman Sachs, engineered by Barack Obama and Larry Summers and Tim Geithner. The leverage now is about almost 100 to 1. $100 of debt for every dollar of deposit, which means that the system is even more unstable today than it's ever been. And the big new crash is coming. And, of course, if you know how to make money as an insider, more money for you, and the rest of the country gets impoverished to an even greater extent than they've already been impoverished. But after all, they're just basically chattel to be disposed of, basically just, consumers.
Well, this goes back to the banana republic concept. And now another headline on this notion of America being a banana republic and the collusion between the government and a select monopolists. Headline reads, Rahm Emanuel and Magnetar, the definition of compromised. So this is from Naked Capitalism, Eve Smith, and she goes into what the definitions of these are. What is a magnetar? One, a neutron star with an intense magnetic field capable of emitting toxic radiation across galaxies. Number two is the actual definition of what she's talking about in this magnetar. It's a hedge fund, the single market player most responsible for the severity of the 2008 financial crisis through the toxic instruments it created. Rahm Emanuel, who is he? White House Chief of Staff, and the politician selected by Magnetar's CEO to be the sole recipient of his political donations from 2006 to 2008. And we're going to go more into this Magnetar story at the end of this section.
Magnetar Fund, fraud. What else?
Lehman channeled risks through alter ego firm. So it has emerged that in the years before the collapse, Lehman used a small company referred to as the alter ego by a former Lehman trader, which was used to shift investments off its books to look like, so that it looks like cash at the end of the quarter. The small company's name was Hudson Castle.
Hudson Castle. You know, what they need to realize is when they get all these bankers in front of Congress to interrogate them about their financial terrorist schemes, they don't need to reform the system so much as administer Thorazine, antipsychotic medication, to Jamie Dimon and Lloyd Blankfein, because they're obviously psychotic. They have alter ego banks where they shovel in debt and pretend it doesn't exist, and everyone's impoverished as a result.
The name of this firm, which hid all of Lehman's debt, was called Hudson Castle. And castle is an appropriate term to use for a system that imposed feudalism upon America. And that a banana republic, let's face it, is a bit of a feudal system.
Right, you have peasants, you have castles. You have lords or Lloyds at Goldman, and peasants, castles, and the serfs. It makes perfect sense. They're trying to hide the fact that they're turning into neo-feudalistic, rigged market capitalist dogs.
Well, the article points out that entities like Hudson Castle are part of a vast financial system that operates in the shadows of Wall Street, largely beyond the reach of banking regulators. So, again, these entities are all legal, and you're going to see this through the other headlines I say. It looks on the surface like a shocking story, disgusting fraud, but they're all legal, and that's because there are no regulators, because the likes of Magnetar are giving the White House Chief of Staff funds.
Well, look, I mean, if I'm Lloyd Blankfein at Goldman, I can say, this is worth $1 billion, and I can sell it to J.P. Morgan, and they'll give me $1 billion, and then they'll give me this for $1 billion in return and say, this is worth $1 billion, and that's legal.
Yes.
That is legal. That's part of this scam, this pyramid of worthless debt. It's all legal.
But the point is, it's more like the empty banana shell there, because this is a banana republic with no bananas. There's nothing there. There's not even a banana there backing it.
There's no banana in the banana republic. It's bananaless.
So another quick headline from the Huffington Post Investigative Fund. WAMU bank execs knew of rampant mortgage fraud and failed to act. Senate probe finds. So you're going to see more and more of these stories. Senate probe finds that they failed to act on the mortgage fraud, but it's all, justified and plausible deniability, and this is the part of the bananaless banana republic having no accountability.
They should make Oliver North the CEO of J.P. Morgan when Jamie Dimon takes over the Treasury Secretary job.
Next, we have a promise to repay. J.P. Morgan Chase says contracts too sacred to give homeowners another chance. So this is the chief executive, David Lauman of J.P. Morgan Chase, speaking before the show trials in Congress. Like all loans, he says, mortgage contracts are based on a promise to repay money borrowed. Importantly, there is no provision in the mortgage contract, express or implied, that the lender will restore equity or reduce the repayment amount if the value of the collateral, be it a home, a car, or a stock investment, depreciates. So he's saying, let them eat cake. Your equity has disappeared. You're underwater. You get nothing from us, who received everything from you, the taxpayer.
That's right. The contracts in this case are sacred, but the contracts that they make when they become government officials, or their fiduciary responsibility, with the emphasis on the second syllable of that word, their fiduciary responsibility is shirked, which is, of course, illegal, and they're committing fraud daily.
Well, as this U.S. bank chief left the show trial situation in Congress, he was mobbed by some angry borrowers led by Bruce Marks of NACA, the Neighborhood Assistance Corporation of America, who said he ran like a dog with its tail between his legs. He was scared to death because he doesn't really want to talk to homeowners.
He got kicked in the knuckles, all right. Will they chase down this dog? What'd they do to him?
The final headline, the Magnetar trade, how one hedge fund helped keep the bubble going. So this is a Chicago hedge fund which was created in early 2006 by a former Citadel banker. His name is Alec Lidowitz. And at the time, the CDO market was basically collapsed. There were no buyers for the equity tranche, the riskiest tranche of these CDO packages. Remember the collateralized debt obligations, which were backed by all these subprime mortgages. Well, the market had basically dried up in late 2005. In comes this fund, Magnetar, which basically dominated up to 65% of the market. They became the CDO market.
Yeah.
But what was unique about them, according to Naked Capitalism, Magnetar's true objective was not to invest in this toxic waste. It took a much bigger short position by acting as a protection buyer on some of the credit default swaps created by these same CDOs. This insurance, in turn, was artificially cheap because over 80% of the deal was rated AAA. Most investors did not understand what Magnetar recognized. This concentrated exposure to the very riskiest type of bond associated with risky mortgage borrowers, each of these CDOs was a binary bet.
So it wasn't enough to trade on inside information. They got the rating agencies like Moody's and S&P to give a AAA rating to something that was essentially worthless so that their insider trading schemes would even be more profitable.
That's exactly right. But, in fact, Moody's refused to rate their last CDO, which totally blew up in a Japanese fund. But what happened is the manager of Magnetar hired a CDO manager rather than choose the CDOs himself. And by doing this, he removed any legal obligation from himself. But he forced the CDO manager to keep putting in the worst toxic assets in those. So he knew it would collapse. He had inside knowledge that these would collapse. And sure enough, according to analysis by ProPublica, 96% of the Magnetar deals were in default by the end of 2008, compared to the industry average of 68%.
Right, well, the rating agencies take turns committing fraud. That's what we've learned in the last, and now, of course, they're attacking Greece and other sovereign states. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away. Much more right after this.
For 6 months, the Russian capital was in a state of siege. Days and nights, people lived in fear of occupation and were preparing for the desperate defense. Intense battles took a heavy toll of lives. But then, the Soviet army switched to the offensive. That was the first severe defeat of the Wehrmacht. Battle for Moscow on RT.
All right, welcome back to the Keiser Report. Time now to turn to a Keiser Report favorite, Joe Wiesenthal of BusinessInsider.com, the man who never sleeps. So Joe never misses a big story in the markets or the economy. Welcome back to the Keiser Report, Joe Wiesenthal.
Thanks for having me, Max.
All right, now, Joe, we were just talking a little bit about the Magnetar trade. Why this story is important, and what does it reveal about the U.S. financial system? Can you go into some detail?
There were a lot of these funds. You know, John Paulson is probably the most famous. We recently heard about Michael Burry and Michael Lewis's new book. These funds that recognized that there was a great opportunity to short housing via take credit default swaps against CDOs built with crappy mortgages, basically. What kind of sets Magnetar apart and why this is getting a lot of attention is because they actually made their trades kind of after the whole CDO boom had kind of started to die down a bit, and they found a way to reignite it, is what the reporters claim, and as such caused more losses possibly than what there otherwise would have been. So they were very clever, and basically what they did was, in order to convince investors that they should get back into CDOs once they were skittish about them, they actually went long the garbage tranche, the worst part, the part that investors were scared about, knowing that they could then short the entire CDO through credit default swaps and take advantage of the fact that even the medium parts would fall apart. So it was very clever, and it was a way of basically extending this trade beyond what its life otherwise would have been.
Yeah, it's interesting. Janet Tavakoli talks about this because apparently the folks at Magnetar contacted her and asked her whether something like this was possible because she's an expert in the field. And she said, absolutely don't do this because it's just unadulterated fraud. And they took that as a good signal to go forward. They said, well, if Janet Tavakoli says it's fraud, it must be good. The U.S. Banking sector is booming at the moment. J.P. Morgan and Goldman Sachs shares are approaching their 5-year highs. So give us the one sentence that explains the monster banking comeback as you talk about it in your column over there at businessinsider.com.
Yeah, simple. Free money from the Fed, a steep yield curve, and an accounting system that doesn't force you to take down your bad mortgages or your bad loans. It's as simple as that. If you can't make a ton of money in that environment, you'll never make it. But right now, it's incredibly easy.
Right. So it doesn't sound so much like an efficient market or an efficient market theory. It sounds pretty much like, as we call, rigged market capitalism. But I think that in the U.S., they condone this as being a necessity to jumpstart the patient once it's had gone comatose back in 2008.
We haven't even really jump-started the patient. I mean, ideally what we'd like to see is banks actually lending into the private sector, to businesses. That would be a good sign, but they're not. Instead, through their fixed income trading departments, they get basically free money, and then they just lend it right back to Uncle Sam at 4% or whatever the 10-year is trading at. It's an easy trade. It's a huge margin, and there's almost no thought that goes into it, making a ton of money on it.
Okay. So it's basically two vampires locked in a blood-sucking relationship, Wall Street and the federal government. As
usual, once again, I don't, which is absolutely nothing new in U.S. history. That is an old story. But, yes, it's the new formation this time. Wow, they should have a Kama Sutra just for banking positions between these two. I'll go into the Keiser Report after dark. All the different ways they've made it over the years. That would be fantastic. Okay, let's talk about China. You've just reported China GDP growth of 11.9%. You write that, quote, make no mistakes, Chinese commodity imports blew the doors off in March. Is this the real thing now in China? Are you seeing the so-called decoupling? Will the GDP numbers from China will it force China's hand on their currency, the yuan? I mean, it's really hard not to be blown away by the growth in China and the amount. And so that is, strictly speaking, it's a positive. And there is, Wall Street might call it decoupling, just based on the numbers and the fact that their numbers are so much better than ours in terms of their demand and what they're doing. But that doesn't mean it's sustainable or healthy. And, the same reason people complain about government meddling with the markets here is going, all those same criticisms apply to the Chinese government. And what you have, the big word right now is you have all these local governments that actually have a significant amount of debt that are completely dependent on the property bubble to continue inflating in order to fund their coffers. So, you have all these imports of copper and iron ore, all these things that go into buildings. But if they're purely for buildings that no one is going to use or that won't be occupied for a long time, and they're only going up because the local governments need a building boom to stay solvent, then sure, it looks like growth now, but it could be very ugly in possibly a short period of time, but no one knows exactly when. Well, it's like the old American adage, fake it till you make it. Yeah, or as Chuck Prince said back in 2007, even though he was aware of the subprime bust, you got to keep dancing. Peter Schiff is right. Mike Shedlock over there on the West Coast, maybe not so right. We'll see how this dueling bloggers works out. Let's talk about Europe for a second. Folks are freaking out about Greece again, and the euro is puking, as you write. Why are people worried about Greece? It's just amazing that this is still going on. The problem now is that, so over the weekend they announced this aid package for Greece, and they laid out very specific terms of how Greece could borrow money from other EU countries and from the IMF, and it all seemed to be done. But, there's still a problem, which is that in many of these countries, they might have to go to the legislatures to actually ratify it. At first, and so you have to figure if you're a local politician in Germany and you have to vote on this, why would you vote for this? Why would you vote for this big aid package to Greece? Your local constituents don't want this. So all of a sudden, I think the markets are starting to wonder whether this aid package is really as ironclad as it was thought to be.
All right, now Morgan Stanley is talking about a Eurozone collapse, and you mentioned a few canaries to watch. Tell us about the Eurozone collapsing and the canaries to watch.
Well, the big one is it's not unrealistic to imagine a point where the so-called rich European countries, like Germany, like France, start to wonder what benefit they see from being in the euro. When the constituents of all these politicians start asking why they're spending their money bailing out Greece, and that's just the beginning, because we're going to have to revisit some of these questions with Portugal and Italy and Spain and the others, and they're going to start wondering why they're spending tax money bailing them out, why their currency is being deliberately devalued by Brussels, so mainly to the benefit of these weak countries. Then that will be the main canary to watch. It could take a while. I mean, something like the euro took a long time to kind of create, and it's not going to be overnight that these countries just ditch the euro. But it could happen soon that politicians start seriously discussing it, that it gets debated, and then you have to wonder, all right, so you have these weak countries on the periphery, you have the main countries debating whether they should stay in it. Why would any international investor want to have their money in euros? And you could start to see a real spiral at that point.
All right, now tomorrow we hear from the Commodity Futures Trading Commission about whether or not they give the go-ahead for a Cantor exchange and their new box office futures contracts. And there's another outfit out there also introducing this concept. You've written a little bit about it. What are your thoughts?
So I can understand why the movie industry is concerned about this. They're concerned about insider trading. They're concerned about the ability to manipulate these markets and perception. They're concerned about the ability of an investor to go in, sell down shares, make it look like a movie is tanking, and derail a project. There's all kinds of concerns like that, so I can understand that. I'm not convinced yet, and I'm certainly open to it, I'm not convinced yet that it's going to be this huge bubble or this huge Frankenstein market that explodes in an ugly way. But that is obviously a big concern. Obviously, you could talk about that more than I could. Yeah, I mean, I'm very curious. And I'll also say that as a gambling junkie, I'm just looking forward to betting on movies, so...
Sure. Well, I mean, one of the big points is that there's systemic problems in these markets with insider trading and market manipulation that come under the purview of CFTC and the SEC and the FSA and regulators all over the world. So why introduce a new one that's so obviously prone to insider information and market manipulation when you haven't done anything to solve the problems in the existing markets? But we're going to talk about this the next time you're on and see how it's trading. I wanted to ask you something before we go. You love the new Kentucky Fried Chicken Double Down Sandwich, which has 2 pieces of fried chicken as the bun.
I want to make it clear. So I had 2 last night, and
you had 2.
The thing is, I actually had 2. So yeah, I'm kind of went overboard with that. I won't say I love it. I'm not even sure I'd get it again because you can't really taste the bacon or the cheese. It mainly feels like you're eating 2 big pieces of chicken. I don't know. It's kind of a novelty. It was amusing the first time, but I'm having a hard time seeing the next time I actually want to get one. That being said, according to the employees we talked to at the restaurant, sales are through the roof. They ran out. They ran out 2 days in a row. So right now it's big, but I'm a little concerned for KFC that this is just going to be a novelty that wears off.
All right, so Yum Brands, which is the parent company of KFC, maybe it's a short-term bounce on the double-down chicken McFango sandwich.
Yeah, I certainly salute them for a brilliant marketing endeavor. I mean, it's hilarious that the fact that they went and did this, a sandwich with 2 pieces of chicken as the buns. Whether this is actually something that people will keep eating, I got to say right now I'm skeptical. All
right, well, Joe Wiesenthal, we're going to have to cut it off there. Thanks so much again for being on the Keiser Report.
Thanks a lot, Max.
All right, and that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Joe Wiesenthal. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.